Give it another few seconds and let people in, and then we'll get started. Okay, good morning and welcome to the ParkBridge Wealth Management Spring Webinar Series. This program is entitled 5 Overlooked Estate Planning Tips to Consider for 2025. As always, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcasts. Today, we're privileged to hear from Lisa Presser and Brian Balduzzi, both from the law firm Faegre Drinker, based in Philadelphia and Princeton, New Jersey. Lisa is a partner at the firm where she counsels individuals and corporate fiduciaries with respect to probate matters, trust accountings, and the ongoing administration of trusts and estates. Her work is in the estate administration area includes post-mortem tax planning and income tax planning. She drafts wills and trusts using generation skipping transfer tax planning, marital deduction planning, and other sophisticated techniques for the succession of family wealth. Brian provides comprehensive legal advice to help entrepreneurs, executives, and families fulfill their goals, offering pragmatic, knowledgeable guidance on financial regulations, laws, and trends. Combining his strong command of trust and estates with his background in tax and investment management, Brian delivers timely and holistic counsel for intergenerational and business succession planning. Today, Lisa and Brian will be speaking about 5 overlooked estate planning tips to consider for 2025. And with that introduction, I'll now turn the program over to Lisa and Brian.
Thank you, Jonathan. So Tax Cuts and Jobs Act, should I stay or should I go? Well, right now we've got a really, really high exemption for estate and gift tax. We're at 13.99, so that you, and if you're married, you and your spouse together could transfer almost $28 million, either during life, by gift, or at death, to the people you love, tax-free. That very, very high exemption is scheduled to sunset on or before January 1st, 2026. Whether or not that will happen, I don't know. Current administration indicates that they may try to extend it, and whether it's extended for 1 year, 2 years, 5 years, or 10 years, we also won't know. But what are we doing, right, to help people, and what should we be thinking about outside of the box? So, among other changes, the federal estate and gift tax exemption will revert back to pre-2017 level of $5 million, which has been and will continue to be adjusted annually for inflation. We believe that if the sunset occurs, each person will have somewhere between 7 and 7.5 million, for a total of between 14 and 15 million that they can pass estate and gift tax free. So we've been focusing for the past couple of years with our clients on using their remaining exemptions before the potential sunset. So what have we been doing? We've been doing a lot of SLAT planning, and that's spousal lifetime access trust. Not talking about that today. Lots of dynasty trust, but lots of ways we get our clients to do present gifts to maximize the exemption they use, and then let it sit and continue to appreciate for the people they love, and usually it's in some kind of a lifetime or dynasty trust planning. But what are the things that we're kind of overlooking? So today we're going to talk about 5 different topics, not necessarily new planning. Some of it is old planning, but stuff we haven't been focusing on during this period of let's quickly use our exemptions before the sunset. So the 5 topics we're hoping to cover in our very short 26 minutes left, are life insurance planning, use of powers of appointment, whether a broad limited or a general power of appointment, QTIP-able trusts, grantor retained annuity trusts, and intentionally defective grantor trusts, and then an estate planning audit. So I'm going to turn it over to Brian, who's going to cover a couple of the topics, and then I will cover a couple more, and then we'll wrap up hopefully in time for the 9 o'clock end.
Thanks, Lisa. So the first topic we'll cover is life insurance planning. Again, as Lisa said, these topics aren't new, but they might be overlooked. We've been so focused on exemption planning and the potential sunset that it's almost going back to basics. Or if you've exhausted those topics with clients, right? What else are we bringing forward for them? What other things are important in estate planning? So why life insurance now? For many years, and I've been practicing just over a decade or so, I did a ton of life insurance trusts. And depending on where you live and what your assets are and why, you might be thinking about liquidity planning. You might be thinking about estate tax. You might be thinking about equalizing estates for business owners that are in the business and out of the business, and what they might receive, and doing irrevocable life insurance trusts for them. However, many of those clients set up and forgot about those policies, right? So you might be working with clients who have on their balance sheet saying, I have a single life, permanent insurance, I have a second to die policy with myself and my wife, I even might have some insurance through my business, and thinking about the Connolly case that came out last year. All of these warrant, perhaps, as we're in a lull or as clients have already used their exemption, thinking about a review of them. How have they performed? Is there still a need for those insurance policies? What was the initial need, and have things changed? Or are there opportunities for new policies? You should also confirm what the ownership is. So I was just involved tangentially on conversations regarding an estate, right? And found out that the policy wasn't titled correctly. And while you can say until you're blue in the face, if you're an attorney or even a financial advisor, you need to fill out these forms in order to transfer it from your name into the trust name or the like. Sometimes clients just forget and don't do it. Following up and creating a balance sheet, right? And reviewing that balance sheet to determine what is the insurance, who owns it, who is the insured, how much is it for, and how is it performing? Perhaps reaching out to those who are life insurance brokers and do these complimentary reviews, and many of them do, doing that maybe every couple of years or so. For existing policies, and I've been helping clients with this, transferring it into an irrevocable life insurance trust and starting the 3-year look back period can be very powerful depending on whether they want to keep those policies. Planning for a business as well. So post Connolly, there was a lot of discussion on the outcome of that case and the use of insurance policies and the relationship that had to the taxable estate. And while the exemptions have gone up, we still do have clients that are subject to either a federal and or state estate tax for which Connolly might be applicable. Reviewing that, not forgetting the fundamentals of just having good planning with insurance. And finally, for clients that are thinking about, I no longer need this policy, I reviewed it, it's not performing how I want, what are some of the ways that we can settle that with a policy settlement, a transfer, and how to make sure that it doesn't run afoul of some of the tax rules for the structuring, or that it's settled in the correct way or sold as part of a third-party auction or something to that effect. So reviewing your life insurance and making sure it still makes sense can be prudent planning, maybe perhaps during the summer months as we're waiting for what will happen with the exemption. For those that are thinking about maybe new life insurance or saying, I don't need it, estate tax exemptions are so high, I don't have to worry about liquidity events, there's plenty. However, there's many other reasons to consider life insurance. And here are just a few that I'll list off. You might consider some liquidity planning in that money can go directly to either the estate, a trust, beneficiaries, without the need for probate or in a more expedited fashion, right? This can be used for paying certain bills, including the lower state estate tax amount. So Lisa and I both practice in New Jersey. There's a New Jersey inheritance tax. I also practice in PA that has an inheritance tax. Lisa and I also practice in New York. All of those have lower thresholds, right? And we might have estates that are subject to a state inheritance tax, unlike the federal. You might also think about life insurance as a tax advantage asset class. That's an emerging area, an idea. You might also consider, and I've done this for many clients, thinking about when there's a lifetime risk of death, a mortality risk that's associated either with an annuity or a trust for their benefit, that they are relying or others are relying on them for the income from that annuity or from that trust. And so one quick example is married couple, one spouse is the beneficiary of a trust for their lifetime, and then upon their death, it goes to further descendants, children and grandchildren. Well, what about that spouse that is married to our income beneficiary that is otherwise relying on the income from that trust? They're cut out if there's not, as we'll talk about in just a moment, a power of appointment to that spouse upon the initial income beneficiary's death. How can insurance provide some liquidity, provide some assurance that the surviving spouse, who is not the income beneficiary, is going to have some liquidity or going to have some assets to supplement if that income beneficiary were to die early? And so thinking about how we might use life insurance in a more creative way can open up some planning conversations from an estate planning, tax, and financial planning perspective. The next topic that we'll talk about is powers of appointment. So as Lisa said, it can be a broad limited or even a general. So these could exist in current documents, or you could be considering more flexible planning, right, in new documents or revisions to revocable instruments like a will or revocable living trust. And so talking through with clients, and this can open up a lot of information about who their family is and who they want to benefit, and what are all of the different circumstances that might warrant what I call a second look, which is how I consider a power of appointment. So someone is a beneficiary under a trust, and upon their death, they can appoint by will to a class of individuals. That permissible appointees is what we talk about when considering whether it's broad or more limited. So it could be to my then living descendants, and then descendants, children and grandchildren and great-grandchildren if they are lucky enough. But it could also include charities. So for folks that are charitably inclined, or otherwise say, I want to provide the flexibility of cycling off different assets, right? Where some is going to go to charity and the remainder might go to descendants that are living. Providing that flexibility helps to manage expectations for wealth accumulation. Perhaps there's a liquidity event within a trust and it grows to a larger extent than the family is comfortable with passing off into inheritance or into further trust. You might also consider, with the estate tax exemptions rising, right, whether you expand a power of appointment to be a general power of appointment, includable in the beneficiary's taxable estate. Why is this useful? Because if it's included in the taxable estate, we get the step up in basis for income tax purposes on those assets that are included in those by that general power of appointment. So take, for example, a grantor gives assets into an irrevocable trust for the lifetime of their descendants in separate dynasty trusts. And upon a beneficiary's death, they have a limited power. But an independent trustee could have the power to expand that power of appointment by formula or otherwise to be a general power that might take very low basis assets in the trust that then get a step up at our beneficiary's death. It's very powerful in order to minimize the capital gains or other income tax consequences if there needs to be liquidity and or sales of the trust assets later. So for existing trusts, we want to know who are our power holders. That could be an income beneficiary. That could even be, in some jurisdictions, a trust protector or someone that holds a power of appointment generally for the trust. Can they exercise it now as an inter vivos, or is it only testamentary under a will? How is this power of appointment exercised? Understanding that for our existing documents can unlock opportunities from one generation to another. We might also consider whether trusts can be modified or decanted to provide a different power of appointment and understanding state statutes that allow as such and being careful there. Finally, that general power of appointment, whether there should be an independent trustee appointed, or maybe there already is one serving, who can broaden that limited power of appointment because of the assets that are in the trust. And so here's where the collaboration between our tax accountants, our financial advisors, our estate planning attorneys can open up something, even if the exemptions were to increase, that can add value to the client relationship. Third topic that I'll talk about real quick is our QTIP-able trust. Here is some additional flexibility, right, for what we don't know will be the exemption at the end of the year or even following, right? So QTIP-able trust is a trust that is eligible in part or in whole to qualify for our limited marital deduction for state and federal tax purposes. The grantor's spouse is the sole beneficiary during his or her lifetime, with all trust income paid to him. This is done by filing what's called a QTIP election on a timely filed gift tax return. Why is this useful? Because we could create a trust today, irrevocable, where we set by formula or otherwise that there is a QTIP-able trust portion, some or all, of the assets that are funded into that irrevocable trust in 2025. Let's say April 15th, just after tax day or just on tax day. You have then another year until April 15th, 2026 to decide what portion of that will be a taxable gift and use some of their exemption, or some that will not be and will qualify for the unlimited marital deduction as a QTIP-able trust, as a QTIP elected trust. Even better, you could put the return, the gift tax return, on extension, or maybe they already are because their income tax return is on extension, and you have until October 15th, 2026 to wait and see. So if Congress is sitting on their hands or has other priorities and we don't have resolution by the end of the year, isn't it great to have that flexibility and determination of how much exemption we might use? With that, I'll turn it over to Lisa for our final two topics.
Okay, so grantor retains annuity trusts. This is one of my very, very favorite techniques in the estate tax and gift tax area. The technique has been around since early 1990s, but people think about it and sometimes they forget about it. A GRAT can be a tool to transfer funds with a very low or almost zero gift tax cost. You cannot allocate your GST, your generation skipping transfer tax exemption, during the initial period of the GRAT because there's something called an ETIP, an estate tax inclusion period. There's a retained interest where the grantor has the right to receive an annuity from the trust for a term of years. We usually do a minimum of 2 years, but sometimes for certain planning, closely held businesses that may be sold in the future, you may want to do something more like a 5-year GRAT or a 7-year GRAT. A lot of it has to do with the grantor's life expectancy, because if the grantor dies during the term, the assets come back into his estate. But if the assets come back into his estate, you're no worse off than you were before you prepared the GRAT. I consider this a foolproof technique. The only detriment is you've paid the attorneys what I consider a small cost to create the trust. But basically, you can zero out the gift by making sure that the annuity that's paid back based on the current, what we call 75/20 rate, the IRS promulgated rate, and every month there's a new rate. If the annuity plus the interest rate is equal to the gift, there's a zero gift. We try to make a very small gift so we can file a gift tax return and start the statute of limitations running on the gift. But it's a really, really great way to use zero or close to zero exemption. And this could be for people who've already used all of their exemption. So we've got those very wealthy clients who've already made that 13.99, gift. And they say, what else can I do? What else do you have in your toolbox? So if the interest rates are low or the asset values are low, and we've had some fluctuations in the market, I'm sure Jonathan could tell us more about that. If we get a low day, that might be the time to take a certain asset, whether it's a stock or whether it's a portion of your business. If you're talking but no agreements or contracts with a purchaser, but something that you can get a lower valuation and you think will rise, and the appreciation, everything over and above what you take back, goes to the people you love with no further estate or gift tax. At the end of the term, and again, I'll just say we've used some stock that was somewhat depressed or depressed plus a lower interest rate environment at the month we created, and you've taken everything back in the 2 years, that upside, the difference, goes to the people you love, either outright or in trust. Usually we have it go to children or trusts for children. And there are many options. Sometimes Brian and I will have clients who have a lot of stock, and their financial advisor will say, well, we've got some, energy stocks and we've got some pharmaceutical stocks. So we'll separate those into sub-trusts so that if the pharmaceuticals rise, but the energy decreases, we don't offset the winners with the losers. We've got separate trusts for different types of assets. I think it's a really, really wonderful way to use no exemption and get potential appreciation out. And in some cases, we've done wildly successful GRATs where clients put something in, they get a valuation at date of transfer, and then subsequent events have a big rise, and the grantor pays income tax also, so that the children or the ultimate beneficiaries don't even have that burden on them. It's a really good tool. Sometimes we've got somebody who's got a large portfolio of their company stock, whether they were a former employee or current, and they say, just do one. Just have it there waiting. And if I see a dip in the market, I'm going to call you. And the document's ready. We just have to change the percentage of the annuity that's going to come back to him. And we can really turn the documents around very quickly. So a GRAT is something that I think everybody should be thinking about. And if you've used your estate and gift tax exemption, but not your generation skipping exemption, at the end of the initial GRAT term, we can allocate GST exemption then, so that there's no tax when it goes down the generations. Another method of getting money down to lower generations is the intentionally defective grantor trust. Grantor establishes a trust, we call it an IDGT, for the benefit of her loved ones. And she says, well, I'm going to structure it as a grantor trust, so to the extent there are income tax consequences, I'm going to pay the income tax. She funds the trust with seed money. And, people can say seed money should be a different percentage, but we usually say at least 10%. So you've got to have some exemption left to do this technique, but it doesn't have to be a lot. So if the ultimate property we want to transfer is worth $1 million, we would have $100,000 of seed money. That would be the initial gift to the trust. And then the grantor would sell assets or business interests to the trust, possibly using some valuation discounts depending on the percentage of the business that is being sold to the trust, and take back a promissory note with interest only paid to the grantor and a balloon payment at the end. We can prepay if the business sells and we have an influx of money, we can pay off the note, but we freeze the value of the assets sold at the time of the purchase, and only the value of the note will be includable in the grantor's estate, and all of the excess will go to the trust beneficiaries. The difference between the intentionally defective grantor trust, which is a little more difficult to paper, is that we can allocate GST exemption on that $100,000 10% down gift, and then whatever's in the trust will be GST exempt even as it grows. So there are two ways to get business interests or lower, valued stock out of your estate, and they're both interesting and they've been around for a while, but I find people have kind of gone away from them, and we're thinking maybe we should come back to them, whether there's a sunset or just because we should remind people about them. So summary of those two techniques: the GRAT, transfer depressed stock or depressed business interest, or something you can get a discount on with a lower valuation. You freeze the value and you transfer the future appreciation gift tax free to your loved ones. You time the funding. So again, you have to work very closely, as Brian said before, on a lot of these techniques with your financial advisors. Watch the market, have them watch the market, look at the 75/20 interest rates. And I think usually around the 17th to the 20th of the month, the IRS tells you the next month. So if you say, oh, well, in May it's going up, we should do our GRAT now. Or if we say, oh, in June it's going down, we may tell our client, let's wait 2 weeks and let's see how things go. And we can consider allocating the GST exemption to use the remaining exemption at the end of the term of the GRAT. For the IDGT, we also review the applicable federal rates for the term of the promissory note. Or we can think about, not subject for today, more sophisticated strategies like a SKIN, a self-canceling installment note, or a private annuity. We can think about the timing of the trust with the funding, with the future appreciation. So you don't want to transfer to a GRAT or an IDGT if you know that come next month, your suitor is going to sign the contract and you're going to be getting a lot more than the valuation you have used 1 month before. So you want to make sure to think about this planning well enough in advance that the IRS is not going to say, you really didn't use the right valuation. And you need to confirm the economics with the business interests. Make sure you've got the ability to service the note or the annuity, and think about allocating generation skipping transfer tax exemption in the IDGT to the value of the initial transfer, or what we call the seed money. So in our 2 minutes left, estate planning audit. So this is what I call an annual physical, right? You go to your doctor, you have a checkup. How am I doing, doc? Well, with your estate planner, oftentimes I'll have a client come in, I know the name, and I look at the file and I see the last touch was 15 years ago. Now, that's not my fault, but usually the clients say, I'm fine, everything's good, I have a will, I have all my documents, I don't need to see my lawyer. So even though we send out a reminder letter beginning with 3 years after the last touch point, if they don't reach out to us, I find people neglect their physical. They don't go to the doctor. I feel okay. I don't need to go for a checkup. But really, you should figure out a reasonable time. So Brian and I were talking to some potential new clients earlier this week, and their family office would like a monthly checkup, which is wonderful, very high net worth individuals. I would say most clients don't need monthly, and maybe they don't even need annually, but certainly every year, 3 years, maybe 5 years. But why? Why do we need that audit? Well, things change, and you don't think about them when they're changing. You may move. You may decide, I have a house in Florida, I have a house in New Jersey, but Florida is going to be my new domicile. The tax laws are better. I'm going to use that as my domicile. But you forget to tell the lawyer. Maybe you're getting married or divorced. Maybe your children or other loved ones are getting married or divorced. We need to think about the results of that. We need to think about prenups for our children or pre-marriage planning for our children. Maybe you've had new children or grandchildren that you would like to put a gift in your will, or set up trusts for, or change the guardians. Oftentimes young couples, they do their first will, they have their first child, they put in their best friends as guardians. Not necessarily what we would recommend. We usually say blood is thicker than water, but you never know the situation. But then those friends move away, those friends get divorced, things happen. You've got to think about those situations. If somebody you love was named as your executor or your trustee or beneficiary, you've got to think about that. Any change in circumstances, retirement, selling a business, somebody who, God forbid, has substance abuse or medical issues or mental, whatever, or you've received an inheritance, right? You all of a sudden got something from your aunt that you didn't even know about living in France, and you've just got $3 million. Things happen. An audit would be really good. So just encourage your clients to meet regularly and to think about just looking at things. We could do a 1 hour or less physical with our clients, and then everybody kind of says, okay, I'm in good shape. Very, very infrequently that we do the update and they don't need something different. Sorry, 1 minute over. Go ahead, Brian.
Oh, we're just going to conclude with some next steps. These were our 5 today. There's many others, hot tips or other overlooked ideas, but insurance planning, reviewing our powers of appointment, both current and maybe proposed in new documents, thinking about that QTIP-able for that flexibility, great estate freeze strategy with either our GRATs or our IDGTs, thinking about GST planning connected with that, as well as Lisa said, those regular audits, those regular touch points or physicals with our clients can unlock a lot of value outside of any exemption planning and the like. With that, if you have any further questions, you can contact us. Otherwise, thank you, Jonathan, for having us this morning.
Great.
Thanks, Jonathan.
Thank you so much, Lisa and Brian. If anyone has any specific questions, new business opportunities, any other issues they'd like to discuss, please feel free to reach out directly to Lisa, Brian, or myself where appropriate, and I'll be sure to include their contact information in the follow-up email of this program. By the way, I wrote a recent article in Barron's on 6 tactical moves investors can make now in light of a down market, which alluded to some of the topics Lisa and Brian discussed here today, in addition to some other ideas. If you'd like a link to this article, you can just feel free to email me, and I could get that out to you. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management-related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more very quick items before I let you go. First, my next webinar is on Thursday, May 8th at 8:30 a.m. featuring Timothy Noonan, partner at Hodgson Russ based in Buffalo, New York, who's going to discuss hot topics in New York tax audits and enforcement. I'll be sure to send out invitations to this program in the coming days. In the meantime, I'd love to continue to grow this webinar community. So if you have a friend, colleague, or client who'd like to be notified of my upcoming webinars, they can simply email me with the word webinar in the subject line. I'll add them to the webinar distribution list. My email is jonathan@parkbridgewealth.com. Second, you can follow all my work on X and Instagram at Jonathan on Money. And by connecting with me on LinkedIn, you can also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my practical planning videos, which I post several times a week, by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.